Here's something most seniors don't find out until it's too late. Right now, millions of Americans over 60 are paying bills every single month that they are completely, 100% legally allowed to stop paying or dramatically reduce, and nobody told them, not their bank, not their financial advisor, not even their accountant. And in 2026, some of these exemptions, credits, and programs are expanding, which means if you're watching this right now, you are in the right place at the right time. So stay with me, because by the end of this video, you're going to know exactly which 5 bills you may be able to legally eliminate or slash, starting right now. Let's get into it. Bill number 1 is property taxes. Now, I know what you're thinking. Property taxes? Those are unavoidable. They're like death and taxes, right? Well, here's what most people don't realize. Every single state in this country has some form of property tax relief program specifically designed for seniors, and the majority of eligible seniors are not using it. In fact, studies show that in some states, up to 70% of qualifying seniors are still paying full property tax when they don't have to. Here's how this works. Most states have what's called a homestead exemption or a senior property tax freeze program. What a freeze means is that once you hit a certain age, usually 65, your property's taxable value is locked in. It doesn't go up. So even if your home's market value goes from $250,000 to $400,000 over the next 10 years, your tax bill stays frozen at that original assessed value. That is thousands of dollars in savings every single year. Now, in 2026, several states, including Illinois, Texas, New Jersey, and Washington, are either expanding their senior exemption amounts or raising the income limits so that more seniors qualify. Illinois, for example, is increasing its senior citizens assessment freeze exemption threshold. Texas already has a strong senior freeze, but the legislature is looking at expanding it further. Here's a real example. Let me tell you about a woman named Carol from Tennessee. Carol is 68 years old, retired school teacher, owns her home outright. She was paying $2,400 a year in property taxes. Her neighbor mentioned the senior tax freeze program at church one Sunday. Carol applied, got approved, and her bill dropped to $900 a year. She had been overpaying for 3 years before that. That's over $4,500 she never got back. So here is your action step for bill number 1. Call your county assessor's office or go to their website right now and ask specifically about senior property tax exemptions, freezes, deferrals, and circuit breaker credits. Those are the 4 things you're asking about. Don't just ask if there's a program. Ask about all 4. And if you need help, most counties have a senior services office that will walk you through the application for free. Bill number 2 is Medicare Part B and Part D premiums, specifically the IRMAA surcharge that most seniors have never even heard of. IRMAA stands for Income-Related Monthly Adjustment Amount, and what it means in plain English is this. If your income in retirement crosses certain thresholds, Medicare charges you extra, sometimes hundreds of dollars more per month on top of your standard premium. In 2026, the standard Part B premium is right around $185 a month. But if your income is over the threshold, you could be paying $260, $370, even $500 a month or more per person. And if you're married, that's double. Now here's the part that gets most people. Medicare looks at your income from 2 years ago to determine what you pay today. So if you had a high income year in 2024, maybe you sold a house, did a big Roth conversion, took a large IRA withdrawal, Medicare is using that 2024 number to charge you extra in 2026, even if your income is much lower now. But here's what you can do about it. Medicare has a formal appeal process called a life-changing event appeal, or technically it's called an SSA 44 form. If your income has dropped because of retirement, divorce, loss of a spouse, or reduced work hours, you can file this form and ask Medicare to use your current lower income instead of the 2-year-old number. And when it's approved, and many of them are, you can eliminate that IRMAA surcharge completely. I've seen this personally with clients and people in this community. A retired couple in Arizona was paying an extra $340 a month combined because of a one-time Roth conversion they did back in 2023. They filed the SSA 44, showed their current retirement income, and Medicare wiped out the surcharge. That's over $4,000 back in their pockets every single year going forward. Here's your action step for bill number 2. Go to ssa.gov and search for the SSA 44 form. If you had a life-changing event that reduced your income, fill it out, attach your documentation, and submit it. Also, and this is important, if you're doing Roth conversions or large IRA withdrawals, talk to your tax advisor about timing those to avoid crossing IRMAA thresholds. A little planning can save you thousands. Bill number 3 is life insurance premiums. Now, this one surprises people. Most seniors are still paying anywhere from $100 to $500 a month or more on a life insurance policy they bought 20 or 30 years ago. Back then, it made total sense. You had a mortgage, you had kids at home, your spouse depended on your income. But fast forward to today, the mortgage is paid off, the kids are grown, and you're now in retirement with savings and Social Security coming in every month. So who exactly are you still protecting? Now, I'm not saying life insurance is always wrong in retirement. There are situations where it still makes sense: estate planning, leaving a legacy, final expense coverage. But there's a large segment of seniors who are paying premiums every single month on policies that no longer serve their actual needs, and they don't even realize there are options. Here's what many seniors don't know. If you have a permanent life insurance policy, that means whole life or universal life, that policy has accumulated cash value, and you have several options. You can do what's called a 1035 exchange and roll that cash value into an annuity that creates guaranteed income for life, completely tax-free as a transfer. You can surrender the policy and take the cash value. You can sell the policy through what's called a life settlement, where a third party buys the policy from you for more than the surrender value. Or in some cases, you can use the policy's cash value to pay the premiums so that you stop paying out of pocket entirely. Here's a real example. A 72-year-old gentleman named Robert from Ohio had a whole life policy he'd been paying $280 a month on for 28 years. His kids were in their 40s, financially independent, and his wife had her own income. His financial advisor reviewed the policy and found $67,000 in accumulated cash value. Robert did a life settlement and received $48,000 in cash, significantly more than the surrender value the insurance company would have paid him, and he stopped paying $280 a month forever. Your action step for bill number 3 is to pull out your life insurance policy, call your insurance company, and ask 2 specific questions. First, what is the current cash surrender value? Second, am I eligible for a reduced paid-up option where the policy stays in force without me paying premiums? Then, talk to an independent insurance advisor about whether a life settlement or 1035 exchange makes sense for your situation. Bill number 4 is income taxes on Social Security. Here's something that will make a lot of seniors genuinely angry when they hear it for the first time. Up to 85% of your Social Security benefits can be federally taxed, but only if your combined income is above a certain threshold. And the formula that determines this is something called provisional income, and most people have never heard of it. The thresholds haven't been adjusted for inflation in decades, so more and more seniors every year are crossing into taxable territory completely by accident. But here's the good news. With the right income strategy, many seniors can legally reduce or eliminate the tax on their Social Security, and some can get it to zero. Here's how it works. Your provisional income is calculated as your adjusted gross income, plus any tax-exempt interest, plus 50% of your Social Security benefits. If that combined number is below $25,000 for a single filer or $32,000 for a married couple, none of your Social Security is taxable. Zero. If you're between $25,000 and $34,000 single, or $32,000 to $44,000 married, up to 50% may be taxed. Above those upper limits, up to 85% is taxable. Now, here's where the legal strategy comes in. If you have money in a traditional IRA, you might be able to shift some of those funds into a Roth IRA through a Roth conversion over several years. Once money is in a Roth, withdrawals don't count toward your provisional income. So by slowly moving money out of taxable accounts and into Roth, you lower your provisional income year after year, which reduces or eliminates the tax on your Social Security. Another powerful tool is qualified charitable distributions, or QCDs. If you're 70 and a half or older, you can send up to $105,000 directly from your IRA to a charity each year. That counts toward your required minimum distribution, but it never shows up in your taxable income. So you satisfy your RMD, you give to a cause you care about, and you lower your provisional income all at the same time. Here's a quick example. A married couple named Jim and Patricia in Florida, combined Social Security income of $38,000 a year, traditional IRA withdrawals of $22,000. Their provisional income was $41,000, which meant $10,200 of their Social Security was taxable. They worked with their advisor over 3 years to do small Roth conversions and started using QCDs for their charitable giving. They got their provisional income down to $30,500. Now only about $4,000 of their Social Security is taxable. They're saving over $1,500 a year in federal taxes, and it compounds going forward. Your action step for bill number 4 is to calculate your current provisional income using this simple formula: AGI plus tax-exempt interest plus 50% of your annual Social Security. Then take that number to a tax advisor or CPA who specializes in retirement income and ask them specifically about Roth conversion laddering and QCD strategies to bring it down. And bill number 5 is long-term care insurance premiums, especially on policies that no longer fit your situation. Long-term care insurance is one of the most well-intentioned financial products ever created, but it's also become one of the most painful bills for seniors on a fixed income. Premiums have skyrocketed over the past decade. Companies that sold policies years ago dramatically underpriced them, and they've been going back to existing policyholders with rate increases of 30%, 50%, even 80% or more, and most seniors feel trapped. They've been paying for 15 or 20 years, they don't want to lose the benefit, but they also can't comfortably afford the new premium. What most people don't know is that you are not stuck with only 2 choices: pay the full premium or surrender the policy. There is a third option that insurance companies are required by law to offer you, and it's called a reduced paid-up benefit or a non-forfeiture option. What this means is that you can stop paying premiums entirely. And in exchange, the insurance company reduces your benefit. Maybe from $200 a day to $120 a day, or from a 5-year benefit period to a 3-year period, but the policy stays active. You stop paying forever, and you still have coverage. Not every policy includes this option automatically, but under most state insurance laws, your insurer is required to at least offer it when they raise your rates. The problem is, they don't always lead with it when they send you the rate increase notice. You have to know to ask. There's also a newer option that's become more widely available called a long-term care and life insurance hybrid policy. If you have a traditional long-term care policy and a life insurance policy, an advisor can sometimes help you consolidate them using a 1035 exchange, tax-free, into a single hybrid product that covers both long-term care and provides a death benefit, often at a more manageable and stable premium. Here's a real scenario. A 74-year-old woman named Dorothy from Michigan was paying $312 a month for long-term care insurance she bought in 2002. The company sent her a rate increase notice saying the premium was going to $410 a month. She was on a fixed income and panicked. She called the insurance company and asked specifically about her non-forfeiture options. They offered her a reduced paid-up option that would give her a 2-year benefit at $150 a day with no more premiums, ever. She took it, stopped paying $312 a month, and still has meaningful long-term care coverage. Your action step for bill number 5 is to pull out your long-term care insurance policy and call your insurance company. Tell them you want a complete explanation of all the non-forfeiture options available to you under your current policy. Also ask if they have a reduced paid-up option or a shortened benefit period option if you stop paying premiums. If you have both long-term care and life insurance, ask an independent advisor about hybrid policy options. All right, let's pull this all together into your 2026 action plan. Bill number 1, property taxes. Call your county assessor and ask about senior exemptions, freezes, deferrals, and circuit breaker credits. Do it this month. Bill number 2, Medicare IRMAA surcharges. If your income dropped due to any life event, file an SSA 44 appeal at ssa.gov and plan your Roth conversions carefully to stay under the thresholds. Bill number 3, life insurance premiums. Review your policy, find out the cash value, and ask about reduced paid-up options, life settlements, or a 1035 exchange into an annuity. Bill number 4, taxes on Social Security. Calculate your provisional income and talk to a tax specialist about Roth conversions and qualified charitable distributions to bring that number down. Bill number 5, long-term care insurance. Ask your insurer about non-forfeiture options and whether you can reduce your benefit to eliminate the premium entirely. Now listen, I want to say something directly to you. None of these strategies require you to do anything risky. None of them are loopholes or gray areas. Every single one of them is completely legal, officially recognized, and specifically designed for people in exactly your situation. The only reason most seniors are still paying these bills is because nobody took the time to explain that they didn't have to. That's what this channel is here for. So if this video helped you today, do me a favor and hit the like button right now. It genuinely helps more seniors find this information when they need it most. And if you have a question about your specific situation, maybe you're wondering if you qualify for the property tax freeze, or you're not sure how to calculate your provisional income, or you want to know more about the SSA 44, drop it in the comments below. I read every single one of them, and I'll get back to you personally. And if you haven't subscribed yet, hit that subscribe button and the notification bell so you don't miss the next video, because we are covering more 2026 retirement changes that could put real money back in your pocket. Changes that most people won't hear about until it's too late. Take care of yourself, share this with someone who needs it, and I will see you in the next one.